Well, for more of the markets, we're joined by Ed Clissold. He's Chief U.S. Strategist at Ned Davis Research Group, and as you can see, he joins us now. Ed, thanks a lot for joining us. You and your colleagues have a view on market declines, that there's a four-step or four-stage bottoming process. I'm sure viewers would love to hear your thoughts on that and where exactly you think we are in those four stages right now.
Yeah, those four steps are oversold, rally, retest, and breadth thrust. So, but the first stage, which we clearly have gone through, is the market gets extraordinarily oversold. And by some measures, U.S. stock market was the most oversold it's been in decades. And that two-day decline of 10% a couple weeks ago was only the fourth time since World War II that happened. The other three were 1987, 2008, and in 2020. So that gives you some perspective how oversold the market was. We have a sentiment composite that takes about 24 different data series. A lot of people will see every day on investor sentiment, and it tied 2018 for its lowest reading on record. So clearly we got that oversold condition. Now the rally usually lasts a few weeks. I mean, the average is 5 weeks, but there's obviously, it's dictated by the news flow. You want to see broad rallies like today, where it's not just the oversold sectors that are doing all the work, that's most stocks going up together. Now, almost always after that rally, there's a retest. A lot of times the S&P 500, the Dow Industrials will make new lows marginally, but you want to see fewer sectors making new lows, fewer stocks making new lows, less volume, signs that like the selling pressure from that initial oversold low isn't as strong, and that's a successful retest. And then from there, you look at something called breadth thrust. It's kind of a funny technical term that analysts came up with a while ago. It just means a lot of stocks rally together, like 90% of stocks above their 10-day moving averages, things like that kind of give us the all clear signal. So we're still on step 2 at the moment. And we got to watch how this unfolds. Sometimes those retests fail. You go back to step 1 and kind of go all, have to start the process all over again. But yeah, we did a lot of correcting in just a few weeks' time, and it makes sense for the market to do some rallying and consolidation here.
Am I hearing you say that investors should be watching for a so-called breadth thrust? That is, when markets rally and many stocks from many different sectors, most stocks from most sectors participate in that rally, a broad-based rally. Is that what you're suggesting could be the sign of a lasting market bottom?
Exactly. Yeah. And that usually comes after a retest. So this could be something that happens several weeks from now. But there's been a couple cases when this happened right away, like after 2018, we had that mini crash in the fourth quarter, and after the 2020 pandemic lows in March, the market just rallied right away. So yeah, look for, these seem to be extremely high readings. You can't just be a day like today. Today's a good start, but you want to see 90% of stocks above their 10-day moving averages, the so-called advanced decline line, running total of stocks that go up minus the stocks that go down in a day. Over a 10-day period, that needs to get extremely high. This needs to happen day after day to get these so-called breadth thrust signals.
There's a fundamental reason for this sellout. However, it's not purely a technical sellout. The fundamental reason is trade policy in the United States and what it could mean to corporate decision making. You make the point in some recent commentary that the 90-day pause on many of the tariffs, while interpreted as a good news story, also means that tariffs stay in the headlines for another 3 months or so. So talk to us about how the market will continue to digest this tariff news, which is worrying on a number of different fronts.
Yeah, so even with the 90-day pause on the retaliatory tariffs, the 10% across the board tariff in the U.S. goes into effect. And by some measures, this is the highest tariff rate in 100 years. And so that's going to have major dislocating factors for global supply chains. A lot of companies aren't really sure what to do. So if you have a capital expenditure plan you're about to execute, probably going to hit pause. If you're a consumer and you're unsure about your own financial situation, you may pause on some big purchases. And so at some point, the risk is this becomes a self-fulfilling prophecy. And regardless of where tariffs actually end up, you could see a severe economic slowdown or possibly even recession. We're not forecasting that, but that's on the table. And considering that valuations were pretty high coming into this correction, there's going to be some more risk of downside over the next few months as we kind of sort this out. So one statistic, again, this isn't a forecast, but your average bear market that has a recession, it's 35% decline over 17 months. So that's, I think, that the worst case scenario here, if just the uncertainty over tariffs overhangs the market and causes a cascade of weaker economic data.
Okay, just before we say goodbye to you, what in particular will you be listening for when CEOs deliver their commentary on conference calls this earnings season?
There's going to be some guidance for the second half of the year. So first quarter earnings have already been brought down as they did in the Q4 earnings season. That's the game they play. But the second half has barely been touched. So let's see if they use tariffs as a reason or excuse to lower second half guidance. Let's look at margin discussion as well. Are they talking about their margins being hit by the tariffs? Now, look, the bank earnings they came across so far, a pretty good sign that the economy was in decent shape coming into all this. So that's positive, but we want to see the guidance coming forward to see this is just a modest earnings slowdown and not negative earnings growth, again, which happens more often during recessions.
Ed, thank you very much for joining us today. Ed Clissold is Chief U.S. Strategist at Ned Davis